In 1913, a group of the world's most powerful bankers met in secret on a private island off the coast of Georgia. What they created would become the most influential financial institution on Earth, one that controls interest rate, prints money, and can make or break entire economies with a single decision. Yet most Americans don't understand what it does or how it shapes their daily lives. This is the story of the Federal Reserve, the invisible hand that quietly controls everything. To understand the Federal Reserve's power today, we must travel back to a time of financial chaos. The late 19th and early 20th centuries were marked by devastating banking panics. In 1907, a particularly severe crisis nearly collapsed the entire American financial system. Banks failed. Businesses shuttered. Ordinary people lost their life savings overnight. It took the personal intervention of banker J.P. Morgan, who essentially bailed out the system using his own fortune to prevent total catastrophe. But this exposed a troubling reality. The United States, the rising economic superpower, had no central mechanism to stabilize its financial system. In November 1910, 6 men boarded a private railroad car in New Jersey, bound for Jekyll Island, Georgia. They traveled in secrecy, using only first names to avoid detection. Among them were Senator Nelson Aldrich, Assistant Secretary of the Treasury, Apiat Andrew, and representatives of the nation's most powerful banks, including Paul Vorburg of Kuhn, Loeb and Company, and Frank Vanderlip of National City Bank. For 9 days, they drafted a plan for what would become the Federal Reserve System. Their goal, they claimed, was to create stability. But critics argued it was a scheme to consolidate power in the hands of private bankers. The truth, as is often the case, lay somewhere in between. On December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The Federal Reserve was born a hybrid institution, neither fully government nor fully private, designed to serve as America's central bank. Structure was deliberately opaque, its independence fiercely protected. From the beginning, the Fed operated in the shadows, away from the direct scrutiny of voters and politicians. What exactly is the Federal Reserve? At its core, it's a system of 12 regional banks overseen by a board of governors in Washington. D.C., the board's chair, is one of the most powerful unelected officials in America, arguably more influential than most cabinet members. The Fed has 3 primary tools to control the economy. Understanding these tools reveals how deeply its influence runs. The Federal Reserve sets the federal funds rate, the interest rate at which banks lend to each other overnight. This might sound technical and boring, but it's extraordinarily powerful. When the Fed raises rates, borrowing becomes more expensive. Mortgages cost more, car loans increase. Credit card rates climb, businesses cut back on expansion, the economy slows down. When the Fed lowers rates, the opposite happens. Borrowing becomes cheap. Consumers spend more. Businesses invest and hire. The economy accelerates. With this single lever, the Federal Reserve can heat up or cool down the entire American economy, and by extension, much of the global economy. Through operations known as quantitative easing and open market operations, the Fed can literally create money. Not physical dollars, but digital credits that expand the money supply. During the 2008 financial crisis and the 2020 pandemic, the Fed created trillions of dollars, purchasing government bonds and mortgage-backed securities to inject liquidity into the system. This power is breathtaking. The Fed can, with a few keystrokes, expand the nation's money supply by amounts that dwarf the entire annual federal budget. No congressional approval needed, no public debate. Just the decision of a small committee meeting behind closed doors. The Fed sets rules for how much money banks must keep in reserve versus how much they can lend out. By adjusting these requirements, the Fed controls the velocity of money through the economy. Tighten reserves and credit contracts. Loosen them, and money flows more freely. These decisions are made by the Federal Open Market Committee, which meets 8 times a year. These gatherings are among the most anticipated events in global finance. Traders, investors, economists, and government officials around the world parse every word of the Fed's statements, searching for clues about future policy. The committee's deliberations are secret. Minutes are released weeks later, heavily redacted. Transcripts appear only after 5 years. This opacity is intentional. The Fed believes it needs independence from political pressure to make sound long-term decisions. But this independence comes at a cost: accountability. The Federal Reserve's track record reveals both its power and its fallibility. During the Great Depression, the Fed's failure to act decisively helped transform a recession into an economic catastrophe. By allowing the money supply to contract and banks to fail en masse, the Fed deepened the crisis. It was a lesson in the consequences of central bank inaction. In the 1970s, the Fed faced the opposite problem: runaway inflation. Prices doubled during the decade, eroding savings and creating economic chaos. Fed Chairman Paul Volcker, appointed in 1979, made the controversial decision to raise interest rates to unprecedented levels, over 20%. The medicine was brutal. Unemployment soared. Recession hit hard. But inflation was tamed, and Volcker became a legend. Then came 2008. The financial crisis that nearly destroyed the global economy revealed both the Fed's power and the dangers of the system it oversees. Investment banks had created toxic mortgage-backed securities, spreading risk throughout the financial system like a virus. When housing prices collapsed, the entire structure came crashing down. Fed Chairman Ben Bernanke, a scholar of the Great Depression, was determined not to repeat the mistakes of the 1930s. The Fed slashed interest rates to zero. It created emergency lending facilities with names like the term auction facility and the primary dealer credit facility. It purchased assets by the trillions. The Fed became the lender of last resort, not just for banks, but for the entire financial system. Critics called it a bailout of Wall Street. Supporters said it prevented another Great Depression. The truth was uncomfortable. Certain institutions were deemed too big to fail, and the Federal Reserve used its vast power to save them. Taxpayers bore the risk. Executives kept their jobs and bonuses. The moral hazard was staggering. When the pandemic shut down the global economy, the Fed once again rode to the rescue. Interest rates dropped to zero. The money supply exploded by 40% in 2 years. The Fed purchased corporate bonds for the first time in its history. It backstopped money market funds, municipal bonds, and even junk debt. The economy was saved from immediate collapse. But at what cost? Inflation returned with a vengeance in 2021 and 2022, reaching levels not seen in 4 decades. Asset prices inflated dramatically, benefiting those who owned stocks and real estate while punishing savers and wage earners. The wealth gap widened. This reveals an uncomfortable truth about the Federal Reserve's power. Its policies do not affect everyone equally. When the Fed lowers interest rates and expands the money supply, those closest to the money benefit first. Large banks access cheap credit before small businesses. Investors with assets see their portfolios balloon. Meanwhile, ordinary workers watch their purchasing power erode as inflation rises. Consider retirees living on fixed incomes. Over a decade after 2008, the Fed kept interest rates near zero. This devastated savers, who earned virtually nothing on their nest eggs. They were forced into riskier investments, searching for yield in a world the Fed had deliberately made inhospitable to safe returns. This was not an accident, it was policy, designed to push money into riskier assets to stimulate the economy. Consider housing. Low interest rates helped make mortgages affordable, but they also inflated home prices to record levels. Young people trying to buy their first homes found themselves priced out of markets, competing with investors flush with cheap borrowed money. The Fed's policies simultaneously made borrowing cheap and assets expensive, a contradiction that benefited existing wealth holders. The Fed's influence extends far beyond American borders. Because the US dollar is the world's reserve currency, the Fed's decisions ripple across the globe. When the Fed raises rates, capital flows out of emerging markets, triggering currency crises in vulnerable countries. When the Fed prints money, it exports inflation worldwide. No other institution has this kind of global reach. This has created tension. Other nations resent what they call the exorbitant privilege of the dollar. They're forced to hold dollar reserves, follow Fed policy cycles, and absorb the consequences of American monetary decisions. Some nations, including China and Russia, have actively worked to reduce dollar dependence, though progress has been slow. This immense power raises fundamental questions about democracy and accountability. The Federal Reserve operates with broad independence, insulated from election cycles and political pressure. Defenders argue this is essential, that monetary policy requires long-term thinking free from the short-sighted demands of politicians seeking re-election. But critics counter that no institution should wield such power without meaningful oversight. Congressman Ron Paul spent decades calling for greater Fed transparency, even introducing legislation to audit the Fed completely. He argued that an institution capable of creating trillions of dollars and bailing out banks should answer directly to the people. The Fed does face some checks. The chair and governors are appointed by the president and confirmed by the Senate. The Fed must report to Congress twice yearly. It releases meeting minutes and extensive economic data. But these constraints are limited. The Fed's true deliberations remain largely private. Its emergency powers, invoked during crises, are virtually unlimited. Some have lost faith entirely in central banking. The rise of cryptocurrencies like Bitcoin reflects a desire for money beyond government control. Gold advocates argue for returning to commodity-backed currency. These movements remain marginal, but they speak to a deeper unease about concentrated monetary power. The Federal Reserve is neither savior nor villain. It is something more complex and more human. It is an institution of immense power, wielded by fallible people making difficult choices with incomplete information. Sometimes it succeeds brilliantly, sometimes it fails catastrophically. Always, its influence touches every aspect of our economic lives. When you take out a mortgage, the Fed has shaped that interest rate. Prices rise at the grocery store, the Fed's monetary policy plays a role. When your retirement account grows or shrinks, the Fed's decisions ripple through those investments. When businesses hire or lay off workers, the Fed's economic environment influences those choices. We live in an age of extraordinary monetary experimentation. The Fed's balance sheet has exploded from under $1 trillion before 2008 to nearly $9 trillion at its peak. We've witnessed negative real interest rates, helicopter money, and asset purchases on a scale once unimaginable. We don't yet know the long-term consequences of these policies. The Federal Reserve quietly controls more of our economic reality than most people realize. It operates in the background of our lives, pulling levers and pushing buttons that determine prosperity and recession, a boom and bust, opportunity and hardship. Understanding this power, how it works, where it comes from, and who it serves is essential for any citizen in a modern economy. The question we must ask ourselves is not whether we need institutions like the Federal Reserve, but how such institutions can be made truly accountable to the people whose lives they shape so profoundly. In a democracy, transparency is not a luxury, it is a necessity. And power, no matter how expertly wielded, demands oversight. The Federal Reserve was created in secret over a century ago. Perhaps it's time we finally brought it into the light.